All right, another quick video that will help us understand what's going on with the adjustments in money supply. Remember, money supply, once again, is deposits plus currency. So how we can impact that is with what we call monetary policy, which again, we'll be addressing more in the units to come. But I just wanted to give you a very basic reminder of how this works. So again, in this one, we covered mostly reserve ratios and open market operations, but I'm also going to go into the discount rate impact as well. So just bear with me. This is how the Fed would inject money into the system. If we want to get a greater money supply, what we're going to do is lower the reserve ratio. So the amount of money banks have to keep in the reserves. So if it's 10%, there's certain money that's going to circulate. But if we lower it to 5%, now they have an extra amount of money to loan out. The discount rate is basically an interest rate. We'll go into greater detail what it is later. But if we lower the discount rate, that means people can borrow money more easily. And so more people will borrow money, which will inject the money supply. And finally, open market operations, which tend to be the most complicated for people. Look at it from the Federal Reserve's perspective. So if the Fed has cash and they want to buy securities, they take the cash, they buy the securities from the bank, that puts money into the system, eventually either as deposits or currency. So the way to look at it is like this. It's very simple. If we lower reserve ratios, the money supply increases. If we raise reserve ratios, the money supply decreases. We lower the discount rate, money supply increases. Increase the discount rate, money supply decreases. If the Fed buys security, the money supply will increase. And if the Fed sells securities to the banks, they're going to take cash out of the system, so the money supply will decrease. Again, in the future, what we're going to do is talk about how these operations will help fix either inflationary gaps or recessionary gaps, but that's in another unit. For now, just understand how we're changing the money supply, because that's what this is about, how the banking system can change the money supply.